Most of us are taught to treat debt like a physical weight. You take out a loan, and immediately you are underwater. Your primary goal is to pay it back as fast as humanly possible before it drags you down. But if you look at how the wealthiest investors operate, you'll notice a strange contradiction. Two people can walk into the exact same bank on the exact same day and take out the exact same loan at the identical interest rate. 5 years later, one person is buried in bankruptcy, and the other is significantly richer. The difference isn't luck. It is that the second person doesn't view debt as a moral failing. To them, a loan is nothing more complicated than renting money. You borrow a sum, you pay a holding fee for the time you have it, and eventually you return it. This diagram illustrates the only equation that actually matters in finance. On one side of the seesaw, you have what the rented money earns when you put it to work. On the other side, you have the cost of the rent, the interest rate. The gap between them is called the spread. If the money earns 7% and the rent costs 4%, you simply keep the 3% difference. By stacking rented money on top of their own, wealthy individuals use leverage to multiply that spread. They aren't trying to pay off the loan quickly, they are focused on maximizing the gap. And the arithmetic gets incredibly interesting when you realize what happens when the cost of that rent drops to zero. We can start testing this math with a tool widely available to consumers, the 0% balance transfer credit card. Lenders frequently offer promotional periods where they charge zero interest on transferred debt for up to 21 months, asking only for a small upfront fee. This chart shows exactly how the spread works in reverse. If you are holding debt on a card charging a 24% interest rate, moving that balance to a 0% introductory card usually costs a flat transfer fee of about 3. The expensive 24% penalty vanishes, leaving a massive void, replaced by a single tiny 3% cost. In this scenario, you aren't taking borrowed money and trying to invest it in the stock market to chase a 3% return. You are mathematically creating wealth by aggressively erasing a 24% penalty. You are using a specialized, cheap financial tool to cancel out an expensive trap. By swapping a 24% cost for a 3% cost, you instantly lock in a guaranteed positive spread. We can scale this same arithmetic up to a commercial level by looking at trade credit. When a business imports a shipping container of products from an overseas factory, they rarely pay up front. They operate on terms, often called net 60. The manufacturer hands over the product today, but the bill isn't due for 60 days. The factory is operating as a 0% bank. Instead of lending cash, they are lending physical inventory and charging absolutely no interest for 2 full months. The business takes that rented inventory and sells it. They collect cash from their customers, pay the factory the original invoice amount, and pocket the markup. They do all of this before the 60-day timer runs out. Look at the mathematical fraction this creates. To calculate your return on investment, you divide the profit by the amount of personal cash you put into the deal. Because the business used the factory's inventory and none of their own cash, the denominator is 0. Dividing any profit by 0 results in a mathematically infinite return. By removing your own money from the equation entirely and relying on trade credit terms, a standard product markup becomes an infinite return. The seller doesn't need personal cash, they need terms to control the spread. Now we scale this to the absolute highest tier, a strategy commonly called buy, borrow, die. Wealthy individuals hold massive portfolios of highly appreciated assets, stocks, real estate, businesses. But selling those assets to fund their lifestyle immediately triggers a massive capital gains tax bill. So they don't sell. This graphic shows the exact math behind their next move. Instead of selling and paying up to 24% in capital gains taxes, they take out a line of credit against their portfolio. Right now, borrowing against those assets costs around 6% in interest. The small 6% loan cost weighs heavily in their favor against the massive 24% tax penalty. It is cheaper to rent money to live on than to sell assets and pay the government. The final step locks the wealth in permanently. Under current U.S. tax law, when the individual passes away, their heirs inherit the portfolio at what is called a stepped-up basis. The decades of gains that were never taxed are wiped entirely clean. The estate pays off the loan, and the remaining wealth passes down untouched by that original tax penalty. But leverage multiplies your position in both directions. If the stock market drops significantly, the collateral loses value. Lenders will issue a margin call, demanding more cash immediately, or they will forcefully sell the assets out from under you to cover the loan. This risk becomes absolute in short selling, which is essentially borrowing in reverse. You borrow a share of stock, sell it, and hope the price falls so you can buy it back cheaper. If the stock price climbs instead, there is no limit to how high it can go. There is no ceiling on the losses. The spread goes infinitely negative, and it buries you. The billionaire tier doesn't function because of secret tax code loopholes. It works because they enforce strict rules to maintain a positive spread, avoiding the traps of infinite loss while renting cheap capital. You probably don't have a massive portfolio of appreciated stock to borrow against this afternoon, but the exact same arithmetic applies directly to the money you manage right now. The interest rate you pay, the rent on the money you borrow, is not a fixed punishment handed down by a bank. It is a highly flexible variable that you can actively push down. Improving your credit score is the single most accessible lever you have to control the cost of capital. Moving from a fair score to an excellent one knocks percentage points off every mortgage, car loan, or business line of credit you will ever take. You automatically widen the profitable spread on every single dollar you borrow for the rest of your life. When you understand the spread, you stop seeing debt as an anchor. By pushing down the cost of your rented money and ensuring what it earns is greater than what it costs, debt ceases to be a master that owns you. It locks into place as a machine that you own.